Hey, what's up, YouTube? Welcome to Super Stock Bros. My name is Ace, and today I'm going to explain to you what's happening with GME and how maybe you can make money from it. All right, so first, the GME recap. What is going on with this stock? Well, you know what? It started off with a funny story from this guy named DFV. Can't say his name on stream, but you know what? It's Redditor. He started putting in a lot of money into GameStop in around like July of 2019. He believed that with the new consoles coming out, that GameStop would be making a lot of money. So he put in around like 90K or something like that, maybe even a bit more in the early days. He started losing pretty heavily, especially with the pandemic kicking in. So he was down about 50% of his initial investment. What happened actually is that it slowly started to recover. And as he had predicted, when PS5 reservations were happening in July, and then finally when the release of PS5 was in November, the GameStop stock shot up because guess what? A bunch of demand for their products and they're making a lot of profit on it. And it's just their name everywhere. You know, as soon as you get eyes on your name, advertising, all that stuff, it's good news. So GameStop was going up. Now, something funny happened because the hedge funds that were betting against GameStop because they thought it was going to go bankrupt were now over leveraged in their short position. So the funny thing is, what happened was with the hedge fund managers that were betting GameStop would go to zero, shorted the stock. They had a huge short position, so they were over leveraged in the short position. They thought it was going to go to zero because from their fundamentals, GameStop is a brick and mortar company that hasn't really transitioned to online very well, and they've been not very good to their customers. So all these things add up to a short position, probably, right? So they were expecting it to go bankrupt. What happened was with these PlayStation consoles and everything like that, DFV, the Reddit user, was correct that GameStop would go up. So they doubled down on their estimate. They thought that, again, GameStop would go bankrupt. They kept doubling down. And it actually turned into a bit of an interesting financial warfare, maybe is the best way to put it, because now all of Reddit on Wall Street Bets, and further it spread into the media, and now a bunch of people are jumping on board, including a few billionaires like Cohen and Chamath, and I don't know if Elon has stock, but he could. So what happened was they jumped on board, and it's just attracting more and more retail investors, and now it's become a war between the hedge funds and the retail investors. Not really about the stock in particular. No one really cares about GameStop, to be totally honest with you, or at least very few people do. But rather, this is a war for the average Joe versus the rich billionaire Wall Street guy. All that aside, that was the main story, and now GameStop has gone up from it was at 4 at a very low point all the way up till now it's sitting at 300 at the time of this video, and it's probably going to go up a little bit more if I were to guess. So that is the recap. Okay, so now I'm going to explain a little bit about what short float means and how it is affecting the current price of the stock. Okay, so this is a big thing that you might be hearing about, and I did mention it in the recap. So what does short float mean, and how does it affect the price movement of GameStop right now? Okay, so as I mentioned, the hedge fund managers, and the site I'm on is FinViz. You can check out a lot of the numbers related to GameStop. Check it out for yourself, but you can see the short float percentage here is 140%. So what does that mean? That means 140% of the outstanding shares are being shorted right now. Okay, so they're being overly shorted. It's actually, there's not enough shares to go around. Reddit picked up on this, and this is what triggered the whole financial warfare kind of thing that I was talking about. Shorts are borrowing from the brokerages that they're dealing with. Okay, so that's just the definition of being short. So, okay, so let's pretend I'm a short seller. Okay, I think GameStop is going to go down, and what I'm going to do is I'm going to short the stock. Okay, so basically what the meaning of this is I'm going to sell a share that I don't have to someone else with the thought process that I can buy it back for a lower price later. So for example, just random numbers here, I sell GameStop to you for $400, and then a few weeks into the future, I buy back GameStop for $200. Okay, so now I'm profiting $200 per share. that I sold. Okay, so does that make sense? I'm selling an orange that I don't have right now to you for $4. And then I'm saying later on, and then this is virtually it's processed, and you get the orange, except it's just like a virtual paper. And then later on, I buy it back. I say, okay, now I can actually buy this orange. Here you go. Okay, so now I've completed my debt. Okay, now the person that's making this exchange in the middle, the person that's giving you the virtual orange, is the brokerage. So you might be dealing with multiple brokerages at a time. Let's pretend you're using like TD Ameritrade, for example. TD Ameritrade loans me a share to give you, and just marks it down as a -1 on my side. And for you, they mark it out as a 1. I've given you a share, and for me, it's just I owe a share to the brokerage. Now, later on, I'm going to have to buy that share back. Okay, I have to cover my position. I can't just not buy it forever. I have to give the brokerage that share back, so I have to buy it back eventually. So what happens if, for example, there are no oranges left? What if the entire world ran out of oranges and I owed an orange to the brokerage? Well, the brokerage is going to come back to me and say, hey, are you going to give me back that orange? And I'm going to say, you know what, I have time. I don't have to give it back to you right now. Eventually, someone's going to create an orange and I'm going to sell it to you. Okay, so don't worry about it. I'll get that orange and I'll give it back to you. But what's happening is Reddit has picked up on this and they're saying, you know what? Don't give away any of the oranges. Okay, we don't want to give these hedge fund managers or these short sellers an opportunity to buy back an orange ever. Okay, so now the supply of oranges has gone down. The price of the oranges has gone up accordingly, because if you reduce the supply in any given item on a market that's in demand, then the price of it goes up. So like, say there's only one orange left in the world and everyone loves oranges, the price of that orange is going to be $1 billion, right? So now, because the supply is limited and the people on Wall Street bets and coordinated, well, not coordinated, but just, media attention and rumors are getting to it. Now everybody's holding every single orange and they're holding it tightly. Okay, so I'm the hedge fund manager. Now I'm starting to panic because now, like going back to that example, I had sold it to you for 400, but now they're worth 1,000. So I'm panicking because, oh crap, there are no oranges left. And I need to buy oranges. And I don't care if it's worth 1,000. I'm losing money on the trade, but I have to give it back to the brokerage because the brokerage is looking at me like, give me that orange. All right, you don't have the right to hold off on this trade forever, and it looks like you're going to lose. So give me back that orange. Okay, so this is called the margin call. They're making me, as the short seller who they trusted, give them that orange. All right, because they loaned it. All right, so hope that explains what a short float is in terms of I loaned out the orange. And then I actually got into what a short squeeze is as well, which is everyone holding tightly onto those oranges. So the prices of those oranges skyrocket. And when I want to go back and buy that orange, it's not available. So they're squeezing me because I have to buy the orange at a higher price. Okay, so that's a short squeeze. What happens when there's a short squeeze? Well, this happens. Okay, so you have GameStop, which was about $40. This was just 6 days ago. $40 6 days ago, and it skyrockets to $400. Remember, I gave that example. Orange starts at $400. There's only one orange left in the world. Everyone loves oranges. It's going to skyrocket. Okay, so it's already going up in value because people are actually, surprisingly, able to hold on to their shares or their oranges. Now, what happens in this case? There's a lot of underlying analytics going on. Bots are going crazy and all this stuff. So one of the things, for example, is there's a derivatives market, in other words, known as options and futures. So in the options market, every single Friday, there is going to be an occurrence where people had bet that oranges were not as expensive as $400 or $350 a piece, right? So they're saying, oh, I was expecting it not to be that much. But guess what? Now, because of my false expectation, there's going to be a ton of more supply bought up, if there is even supply to go around. So that's going to happen. So this price might actually skyrocket even a bit more in the short term. All right. I don't know. I don't know for sure. Who knows? But that's the expectation, because remember, the short float is 140%. Everyone is already demanding to get to fulfill their short position. They have to cover their short position, and the options people also have to fulfill their short position. So there's a bunch of things happening right now that's going to contribute to this price increase. Okay. All right. So that is the total recap. I hope that explains what that means. Again, just quick recap. Short seller, I had pretended I had an orange. I asked the brokerage to give you that orange on my behalf. The brokerage says, okay, but now you're going to owe me an orange eventually. There are no more oranges left to go around, and now I'm panicking because the orange price is going up like crazy and there's not enough supply to go around. So I need to buy back that orange as quickly as possible to give it back to the brokerage, who is now asking, they're demanding for it. Hey, I've given you enough time. Give me back that orange. Okay, so that's the short squeeze, and how appropriate squeeze with oranges. Okay, so next, how can you make money on this? Well, this is not a recommendation. I've been trying to do this. I haven't been very successful. The thing is, you have to be very, very good with your timing, and you have to take a huge risk. So I do not recommend it. I'm the guy that says take low risk maneuvers and try your best to be consistent gain. But if you want, I'll give you some plays. Okay. So first play, sell puts on the way to the top. Okay. So what you can do is you can sell a put option at, say, like 160 and collect the premium. If you know this will work, if you know that GameStop isn't going to go below 160 anytime soon. So you can collect the premium. Hopefully the put expires by the time, either the week goes over or the next week is over, and you can just keep the money free and clear. If it goes below 160, you owe $16,000. So just be very careful. Okay. And you can swing it too. So you don't have to wait till expiration. If it goes up double again for the reasons we were suggesting with the short squeeze, then you can just do a quick flip. Like you might make your premium here, which might be like $3,000. And then if this doubles, you can actually sell this for or buy it to close it at a lower premium of like $1,500. So you might profit $1,500 right off the bat. Okay. So like that was just for a short squeeze. Okay, so personally, the play I'm thinking about is buying puts to profit from the downside when this thing eventually comes down. I hate to say it, but it's probably going to happen eventually. I don't know when it's going to happen. Might be a couple weeks, might be a couple months. Who knows? But when it's going to come down, it's going to come down hard. So you can buy puts to profit from the downside. So how would you do that? Okay, well, let's look at the option chain. So let's open up GME here. It's a little small, I know. It says GME. And you can look at the option chain for, say, 2 weeks out, all right, 16 days till expiry. Okay, so you would come over here to the GME option chain. You would look to see, I would probably do 16 days, and then you can look to see some of the out the money puts. Now, you might not expect it to come down to $6. I mean, I don't expect it to come down to $6, but you would be profiting on the change. So, for example, this change was huge. It went up from 6 cents to 34 cents. Okay, that's a massive change. You would have 6 times your money just on the way down. So what you can do is you can do something like that. Wait till GME is at the top. And then if you think it's going to come down, you can think about this play. So you would put this on the ask, and then you would go ahead and buy it, like 10. And then you can buy, so this would be $300. And if it quadruples up, then you can sell it and you can make $1,200. Okay, so that's what you can do. So that's how you buy the GME option puts. That's how you profit on the downside. Now, I don't think that's going to happen for a while, but this is just, if you were to ask me, how is it possible? That would be the play that I would probably make. But I don't know. I'm not suggesting that. Now, that's all I wanted to talk about. And like I said, this isn't really betting on GME as a company. This is betting on the story. This is a Wall Street bets and all of the retail investors versus the hedge fund managers and stuff like that. Personally, I don't recommend getting into this play. It's a little too risky, but if you want to, go for it. And if you're standing up to the man, all the power to you. And until next time, bros, let's make those gains.